Generally speaking, this is a really good strategy because it stops you from... Hey everyone, so this video is inspired by Brandon over at New Money. We were having a chat during the Movember fundraising live stream event, and he brought up that he has Tesla stock and is feeling unsure about whether he should sell some, sell all of it, or just hang on to it and see what happens. So today, I'm going to give Brendan some options for what he should do. Now, if you ever find yourself in this great situation where you have had an investment perform really well, and now the size of this investment is getting impressive, so impressive that you are kind of scared to lose it, well, I think this will help. So here are my 5 strategies for dealing with this situation that you can implement if any of us get into this situation, which I think we will one day. Поехали! So I'm going to put myself in Brendan's shoes. Brendan has a big stake in Tesla stock. So I'm trying to think about what it would be like to have a huge part of my portfolio in Tesla. And I'm also going to assume that he really likes Tesla and he thinks it's going to be a lot bigger in the future. And he loves Elon Musk and wants to back him. Now, I could have replaced Tesla with Bitcoin or one of my favorite companies like Constellation Software, and it would still be the same situation. Essentially, what we have is an investment that's starting to take up a huge part of our portfolio, and we're not quite sure what to do next. So the first strategy we're going to look at today is called taking the principal approach. And this is something my uncle taught me about 15 years ago. I thought this was a pretty smart strategy. So the theory essentially is that, let's say you have an investment of $10,000 and it moves up to $15,000. So it's gone up 50%. What you then do is once it hits a certain level, maybe it's 50%, maybe it's 100%, something like that. You have like a rule, like a hard and fast rule. It's like it's always this 50% or 100%. You take out the principal, go and invest that principal into something else and leave whatever's left over behind and leave it alone. So that's called taking the principal. What essentially you're doing is taking all the risk off the table. So in that nice, lucky situation, well, whatever happens to the money that's left there, it doesn't really matter anymore because you can't lose. It's an asymmetric risk from there. It's zero downside and only upside from there. So I think that taking the principal approach might work if I was in this situation with Tesla stock, let's say, for example, and I had those same assumptions, maybe taking the principal is a good idea, therefore I can't lose. The second strategy is called the coffee can approach. And essentially this is when you make an investment, if you're going to think long-term about it, you've got to think long-term about it. And the coffee can idea is, it stems from when you used to have physical stock certificates. You could put them into a container or something that you could seal and hide it, put it like far in the back cupboards of your house and move on with your life and forget about it. You put it in the coffee can and forget about it. And maybe on your 40th birthday or your 50th birthday, you go, I wonder what's going on with that investment. Or maybe you give it to your kids one day and go, whatever's in this coffee can is yours, and they have to go and find what it's worth. It's called the coffee can approach. If you, generally speaking, this is a really good strategy because it stops you from paying attention to the stock market, paying attention to prices, and just letting whatever's in that coffee can do its thing over a long period of time. Maybe some of those investments do poorly, but some of them will probably do amazingly well if you've chosen any good companies in there. You only need to do one or two of the 10 or 15 in the coffee can to do really well, and you can make huge money over a long period of time though. So the third strategy is a combination of the first 2 strategies. So it's essentially you're going to take the principal and then put the rest of it in the coffee can. So once it's gone up 50% or 100% or whatever, take the principal out. Whatever's left behind, you put it in that coffee can approach. Obviously not a physical coffee can, but leave it into your stock brokerage account to not be touched until you're 40 or 50 or whatever. Therefore, you can move that principal over into something else, and anything that then goes into, maybe you have a separate brokerage account for this particular activity. And what you're doing is every time you're taking the principal, putting into something else, that grows, gets to 100%, you take out the principal again, then you move that money into your coffee can brokerage account essentially and leave it alone. So the principal plus the coffee can approach I think would be a good strategy. Now, this next strategy I actually got from my friend here in Ukraine who has been doing this with cryptocurrency. So what he's been doing is he has been putting money into, I don't know, Bitcoin. I don't know, I'm just going to guess Bitcoin. And because it's had such an epic last couple of years, every time it reaches, his theory is once it gets up to the value of 3 apartments, he takes enough money to buy 1 apartment. So he's moving it from what he thinks is an unstable, risky asset, but it is growing, and he thinks it's a good investment. I'm not going to argue at the moment about that. It has worked out for him so far, but he's moving into something that he understands and that he thinks is a lot safer, and that is his real estate investment portfolio. Totally fine with this strategy. It's not something that I would do. I wouldn't be in crypto or real estate, but for him, it works really nicely, and he's been able to accumulate a handful of investment properties now. Now, this is a pretty good strategy, but the issue with this one is, well, why do you, because let's say it's $100,000 to buy an apartment. So let's say he gets up to $300,000. He takes out $100,000, buys an apartment, so he has $200,000 left. That builds up to $300,000 again, takes out $100,000, goes buys an apartment with it. The issue with that is, well, you're only compounding the $200,000 each time. But let's say you let it run and got to the worth of 5 apartments or 10 apartments, and then every time it goes from, let's say it's 10 apartments, let's say you get to $1 million. You take out enough money for 1 apartment, so down to $900,000, put that in. The $900,000 going up to $1 million is it only has to go up 10, 15% to get up to $1 million. So it doesn't have to grow much before you make another investment. So there's a bit of a game to be played in where you start taking out the money and how much you want invested in, or maybe your net worth. You don't want 100% of your net worth tied up into this thing, Tesla or crypto. So maybe that wouldn't work quite well, but 3 seems, that was probably a good, that worked for my friend. So maybe that would work for you. So this strategy assumes you know how to value the investment, and you sell when it's silly overpriced. So my idea would be to put a fair value on the investment. So let's actually try to work out the fair value of Tesla or Bitcoin or whatever it is, and triple that fair value. Then that's when I would sell if I had something else to invest into. Because once it gets 3 times overvalued, I think once it gets 2 times overvalued, well, I could be wrong. Maybe my valuation wasn't right. Maybe it's not necessarily a sell when it goes double past my fair value. I could have been too conservative with my numbers. Maybe 2 times over what I think fair value is maybe not that overvalued. But 3 times my fair value is seriously overvalued. The chances of me getting the return from this point onwards is far lower because I've worked out its fair value. And I would like to then move it into something else to invest into. If I didn't have anything to invest else into, I might just leave it until I find something else. But I'd be working really hard to look for another alternative investment. For me, I would be looking at another company trying to invest that I think is below fair value. But if you can't value the thing accurately, then maybe go with one of those previous options. If I'm going with the coffee can approach, now I want a brokerage account that will be around in 10 years' time. Brokerage accounts are businesses as well, and they go bankrupt. So don't take this decision lightly. I think Interactive Brokers is the best. I only recommend them because I think they are the safest. I don't think there's any point saving $1 or 2 in commissions if the risk is higher that you could lose it all. Remember, if it's the coffee can approach, you need this to be around in 10, 20 years' time. There's a link in the description for those interested in taking a look at a demo account and getting a feel for it yourself. So maybe you will be in this situation one day where you have something take up a big part of your portfolio. If there's any indication that this video wasn't a complete waste of my time, that would be greatly appreciated. Maybe just press that like button for me, that would be nice. And I want to say thank you to Andy Toll, who is one of my subscribers. You've always given me some great comments and some great things to think about. You're a legend. Thanks for everyone for staying to the end, and I'll see you next time.